Hi, I'm Peter Mallouk, and this is Icons and Ideas. On this show, we basically meet with titans of industry and thought leaders. And today we're going to have one of my favorite guests, the author of Stocks for the Long Run, a book I read when I was very young that shaped my thoughts around finance and the industry. We're going to be talking with one of the financial industry's greatest investors and teachers of all time, the Wizard of Wharton, Jeremy Siegel. Jeremy, thanks for being with me today.
Happy to be here, Peter.
I got to ask, because I introduced you, I talked about that book. You wrote it so long ago. It was so powerful. I mean, everybody in finance has read it. It's so accessible to even young investors. When you hear someone talk about that, are you proud of that? Are you like, my God, I've done 100 other things? Like, what is your mind go? Where does your mind go to when people talk about that?
It is my signature work, I would say. I first did a 1994 Stocks for a Long Run. I was an unknown author.
Right.
I had trouble getting a publisher, actually. Finally, when I did find a publisher and put it out, and there was like no advertising whatsoever. But a few people read it, and it got reviewed in Business Week extremely well. It got the Financial Post in Canada. He said, when I read that, it was like eureka. I finally understood why I like stocks for the long run. And then all of a sudden, I was invited to so many conferences, and I loved it. Where they passed out my book, and now it's in the 6th edition. So we're talking about 1994. Almost 32 years later, and almost 500,000 copies. So I'm very, very proud of what I did, and I'm happy that people have found it so useful.
And mandatory reading for any even semi-serious investor.
It wasn't just for the professional. I mean, I try to avoid jargon. There's a few places where I'll introduce it, but you don't really need it. So what I'm proud of is that the intelligent investor can understand it, but it has also been used as textbooks at universities for equity study, so that I could actually cross all those different angles. Because don't forget, I was a university professor for 49 years and taught almost 10,000 students. So that was my main profession, and that it got such good reception, not only among the professional down in the trenches that are actually working with clients to do well in their portfolio, but also got acceptance among the academics.
Yes.
And what could you ask for more? And that's been so gratifying.
So the last guest on our podcast was Mark Rowan, who's the managing partner and CEO of Apollo, which is one of the biggest private investment firms in the world, the king of private credit in the world. And he told me that the only B he got was in your class. So you were tough.
I was a tough grader.
He must have been a tough grader. Tell our listeners the thesis of that book, because what I want to do is talk about what's going on in the world today and what maybe thoughts you've maintained and what may have changed.
I remember after the 2nd edition, I had a reporter once ask me, he said, Jeremy, this is a great book. There's so many ideas, 500 pages. Could you summarize it in one sentence? And, I got back to him and I said, I think I can summarize the thesis of stocks for the long run. Stocks are the most volatile asset class in the short run, but the most stable asset class in the long run. And that just came out of that chart, that's in the first chapter of the book, that I spent almost 3 years researching historical returns on stocks, bonds, treasury bills, and all the rest, that just you see it right away. And and it was published in the very well-respected academic journals before I actually even produced the book Stocks for the Long Run. And I think that thesis, that if I have that long horizon, I'm actually having a much more stable asset than all the headlines, that of volatility that we all know about, that stocks suffer in the short run.
It's interesting, because when clients, newer clients that maybe aren't really comfortable with investing, they see the stock market as a casino. And the way I explain it to them is it is a casino, except you're the house.
Yeah.
You know, if you're the house,
Exactly.
yeah,
The odds are with you.
That's
Yeah,
right.
It's one of the few things that the odds are
Yeah.
definitely with you.
Yeah, the short run, you don't know what's going to happen. You play a hand of blackjack, it's almost 50-50 what's going to happen. But
That's
you
a
play
very good
thousands of
analogy.
hands over a decade. If you're the house, you are going to win.
You're
right?
gonna
And
win.
That's basically how the
And
stock
you've
works.
always won in the long run in the stock market. In fact, when I did the historical research, with reinvested dividends and after inflation, I found out that there was rarely a period more than 10 or 12 years where you weren't actually got a positive return after inflation.
Right.
And I mean, this chapter starts out with really talking about the stock market in 1929 to 32, which, scared people away from stocks for over a generation. And yet, if you kept on investing in that, you surpassed all other investment assets.
Is there anything from that book, I mean, because you're talking 1994 to now, a lot has happened, that you've changed your mind about, or that you see differently? Or do you see the last 30 plus years as more, obviously it's validating, but is it more validating? Are there some exceptions? How do you feel now about it?
Well, it's interesting. When I finished the 6th edition of the book, I went back to the 1st edition. I looked at the long-term real returns on stocks, and it was 6.8% a year. And then there was 30 years in between. And guess what? It was about 6.9% per year after inflation. I mean, it was virtually the same. And look what happened over the last 30 years. From 1994, the great financial crisis, the pandemic, one could go on and on and on, ups and downs, major bear markets, and yet that 30-year return virtually matched the long run. Now, there certainly, are definitely changes, but I think some of the important truths that I had learned about how stocks, give you that steady best return in the long run absolutely persisted over that period. I have one chapter called Calendar Anomalies, and some of the anomalies are not quite the same. I compare them to what we had there. And everyone talks about, how bad September is, the summer rallies, the Christmas effect, and all the rest. And I go into some of those, and some of those have shifted. But the most major theses are definitely there. I think one of the things I did get to appreciate more as time went on is that people buy bonds as hedge assets. How good are they as hedges against stock market volatility? And it turns out that they're very good hedges against recessions, pandemics, financial crises, recessions. They're very bad hedges against inflation.
Oh, no doubt.
Yeah, and so as a result, a lot of, when you take a look at bond movements, everyone's trying to talk about inflation and all the rest. They're not considering the fact that if you really fear inflation risk, you want to be with equities. You cannot be with bonds. And certainly, that is, a big concern. It's always been a concern under our fiat money economy that we really got in, certainly since Roosevelt went off the gold standard, and then internationally Nixon went off the gold standard in 1972. The world is on a fiat money standard, and there's a lot of advantages of it. There's no question. We've avoided Great Depressions as a result of having that flexibility, but the bias is to inflation, and that is bad for bonds, but not bad for stocks.
Yeah, there's no consequences for short-term spending. Some future president, some future Congress has to deal with those things. We've had a lot of bear markets since your book came out. We had 9/11, we had the tech bubble, we had 08-09 crisis, but the one I want to get your thoughts around is the quick market drop during COVID. Stock market went down 34%. Average bear market's a 34% drop. Not unusual, but for two things. One, the fastest 34% drop in history, and two, we all thought we were going to die, right? So everyone was very, very scared. But the government intervened in a way that really was, I think we're still dealing with it today. How do you feel about the way Congress, the president, the Fed intervened? Do you think they did the right thing? What do you think what after effects do you think we're dealing with?
And I have a whole chapter in the 6th edition called the COVID pandemic and the stock
Okay.
market. And I go in, and this is where my training, my training was in macroeconomics and monetary theory. I got a PhD at MIT. Everyone thinks, oh, where did you, learn the finance? And the truth of the matter is, I got into finance from macroeconomics. I was very close. I was colleagues of Professor Milton Friedman when I taught at the University of Chicago. His teachings influenced me. I knew him personally. I was personally friendly with him. He was the one who told me that persistent inflation is always caused by excess monetary expansion. And what really happened during that period? Now, we really had Trump had 2 stimulus. The first one is needed. We didn't know what was going to happen.
We really did think we were all going
The
to
second Trump one was beginning to get a little excessive, but it's okay. But under Biden, very honestly, it just went overboard. We didn't need, $5 trillion worth of stimulus.
Yeah.
And this is the big problem. This is why I criticized. I said from the very beginning it was never temporary. I was the first one to write articles saying this is going to be permanent, high inflation. I mean, it'll eventually tail off, but it's not going to go back
here
down.
we are more than 5 years.
Yeah, I mean, Jay Powell just printed the money and handed it to the government, which is, again, it was like I was thinking back when I was a young assistant professor at the University of Chicago at the lunch table with Milton Friedman, and and he said, Jeremy, if you're going to burst of the money supply, and we had the biggest 2-year burst in 150 years on my side, he said, I guarantee you're going to have inflation, and there's going to be no way it's temporary, and there's going to be no way around it. And so here I was, basically having just retired after nearly a half a century of teaching, remembering the lessons that I learned at the lunch table with Professor Milton Friedman in the early 1970s. It was really, to be able to say what you learned in the past still has relevance today with the world changing so much was, very, very gratifying.
Well, it's incredible what we're watching now. We're still living with housing and the effects of that policy.
Oh yeah, there was just no reason. What I said, people said, well, what should he have done? I said that what the monetary authority should have said to Biden was, you do your fiscal policy, but we're not going to hand you the money. You go to the bond market.
Right.
And then the interest rates would have gone up right away, and we wouldn't have anywhere near the spending, boom that was going. We were buying mortgage-backed securities at a time that we had, the biggest 2-year increase in housing prices in our history was between March 2020 and March 2022. It just, and we were trying to support a sector that was in a runaway prices. It just really upset me.
Yes.
I said, these people that have not, I guess it's because of my age, and I studied on Friedman. Why was all this lost?
I think it was terrible because if you look at like the past bear markets, they said, oh, well, we got to do all this spending because 08, 09, everyone's scared to do anything, or 9/11, people are cocooning. It made sense to do this. With COVID, people wanted to spend. They were inside because they thought they were going to die. They did not need stimulus. They just needed to know they could go outside.
Absolutely.
And they were going to spend. So then they went outside with big bags of money and were
you're right.
surprised that everything cost
The
more.
only thing that was done after the financial crisis was the cash for clunkers. Do you remember that?
I do remember.
And that was like 800,
Right.
billion. Oh yeah, we're not going to make that mistake. We're going to go to like 8 trillion.
Yes.
Hey, come on. Once people, saw that not everyone was dying and there was a vaccine within a year, right? Less than a year.
And if there was no vaccine, there was
And yet we were still passing out trillions of dollars. When I was traveling around, and as soon as I got the vaccine, and I was traveling around doing everything like that, and money was still flowing.
Right.
It was a terrible monetary and fiscal mistake.
And the hangover effect I think we have is you have this division now that's greater than ever between the working class and the wealthy, because the wealthy owned stocks. They had 401ks. They had a lot of
And they
equity
had
in their
property
homes.
that went up in value.
That's right. And the working class just saw the price of everything go up 30% and didn't have those things. And so,
If you don't have a home,
yeah,
you are now so disadvantaged and priced out of the market. I mean, it was like the haves and haves not. Now, in the United States, we have a big home ownership ratio. It's around 65%, which is bigger than Europe and many other places in the world. But that still means, more than 1/3 of the people don't have a home or rental. And now there's like almost no chance that they can buy a home with the current prices and the current interest rates. So that it wasn't just the stock market that widened the gap. I think in many ways it was the housing market
right.
that really began to widen that gap.
So on the same theme, what do you think about the deficit spending? Now we're adding almost $1 trillion a quarter. I mean, numbers that were unfathomable. I mean, just 7, 8 years ago.
Yeah.
What do you think the impact is on the economy, the society, the stock market, the bond market?
Okay. The long run is unsustainable. I'm not going to say. I mean, with Medicare and the aging of the society, you can look at that. However, I'm not worried about the short run or even the medium run. I think there's capacity. I think I look at different ratios in this debt to income. I look at debt to wealth. And wealth is growing a lot more than income because how much of the world's, of the U.S. portfolio is occupied by U.S. government bonds? That's not nearly as scary as the debt to income. And also the projections of income. And this is where AI comes in. If AI can raise productivity a mere 0.5% a year, that really lowers the longer term trajectory of the debt to income ratio into the future. Secondly, I don't worry about the debt unless the bond market worries about the debt.
It's starting to worry, don't you think?
Yeah, I know it. Not really.
A little
I mean, it's got to worry like, well, I often tell, during the Reagan administration, when he cut taxes, the bond market worried it went up 100 basis points, and he had to backtrack on one of his signature policies. Then once he backtracked, we had some of the greatest growth in those next 8 years that we've had. Bush House, it's similar. The biggest example is Liz Truss in the UK. Now, she just cut taxes without any spending, and the bond market told her no, and she was out of a job. She's the shortest serving prime minister in UK history. So, you know what? The bond market will tell us. I don't see it. Yeah, I know, we do see the 30-year. We see internationally a little ripple. And we see the 30-year, had broached 5, now down to 4 3/4. But, the 10-year, which I really look at as the benchmark, is, really just about 4. That doesn't signal to me worry about it in the short run. Now, I'm not saying, there'll never be a problem, but I don't think it is anything that I see as a near-term problem for the stock market.
Interesting. So when you look at Japan and China starting to pull away, and you don't view these as early warning signs, you just view them as normal.
Well, they could have their own problems. I mean, just like what happened in the UK, and she was out, and they didn't do those tax cuts. So the bond market, the bond vigilantes, as they're popularly called, they'll change. They'll call the tune.
Right.
If I see the 10-year moving up to 5, 5.5, without any other factor, and persistent inflation, not temporary inflation like tariffs. And all of a sudden, you're going to get screaming, yelling from everyone in the housing market, the builders, people trying to finance long-term investment, just like Reagan had to go back, Bush had to go back, UK had to go back. The politicians must respond to the bond market. I don't see the bond market is whispering a little bit, but at this particular point, I don't see that as being a factor in the next 3 to 5 years.
Oh, wow.
And I know I'm in the minority, and people say I'm playing glossy and glasses on and looking at a rose-colored. But I've done a lot of research on this, and as I said, I'll let the bond market tell me, and then the bond market will discipline the government on that.
Do you buy the argument the bond market's smarter than the stock market in the short run?
It's populated by different group of people. Don't forget, earnings is a big driver, which has nothing to do with the bond market.
Right.
Faster economic growth is good for the stock market, not good for the bond market because it means higher interest rates. So, inflation, which in the long run is not bad for the stock market, although in the short run could give it problems because the Fed would have to react, is really bad for the bond market. So there's a lot of different factors. So the people that are really smart in the bond market, on those factors that they're looking at, will be better. But stock investors are looking at earnings and the rate that they're capitalizing those earnings at, which is related to the bond market and a lot of other factors, risk premiums and all the rest. So the groups look at different factors. I wouldn't say one is smarter than the other. It's just that they look at different factors. However, that being said, I agree with you that in terms of a unsustainable longer-term deficit, the bond market would tell us first.
Yeah.
And right now, despite these flutterings, I don't see it. I'm not saying it's never going to happen, but I really don't see that right now.
Of all the threats to the American economy, what do you see as the biggest threat? I mean, a lot of people say it's deficit spending, the national debt. You don't seem as concerned about that as other people.
I'm not as concerned about that.
So what do you see of all the threats that are out there, or do you see none of them as a serious threat?
Well, I think there are threats of cybersecurity. I mean, I think it would be a nightmare if everyone got up in the morning and tried to log on to their bank account or their fund accounts and nothing came up.
Yeah.
I mean, who knows? I think we have to treat that very much like national defense.
Yes.
Because we can get a cyber attack can be as deadly as a military attack. We also have an aging grid, which we have to worry about. We have power needs that we all know that we have to take care of. I think that those are, to me, more threatening than the government deficit.
Interesting.
Right now.
Yeah. So I agree with you on cybersecurity. I talk when people ask me what I think the biggest short-term threat is. I think it's exactly what you said. Even if everybody got up and knew that $1 was taken out of their account, right? But it happened to everybody at one major bank.
Yeah.
That would be paralyzing to the U.S. economy.
It would be
It
totally
would be
paralyzing.
absolute chaos.
If something, one of the big
Yeah.
banks like J.P. Morgan or something like that
100%.
suddenly was raided for money, it would be paralyzing. And another thing I think is going to be very important, and that is identity theft with AI.
Yep.
And can we be assured it's you who wants to do this transfer, and now knows all the questions that they try to ask you to make sure that they know that it's you.
And they've got your voice.
And they got your voice, and they got all your details. How are we going to identify people in the future?
Right.
We have to work on that because trillions of dollars are transferred all the
Right.
time.
Yep.
And you can see what the potential of abuse and problems is in that area.
Yeah. I think about AI a lot. I think about cyber a lot because I think we've made a lot of enemies and they hate us more than ever. And we're dropping bombs all over the world every year on somebody, and no one can defeat the United States militarily, but a lot of people can spend their money on cyber, and this can be the way they can really paralyze a nation.
I think I know almost everyone I know has had some cyber problem.
Right.
Maybe they paid $50 to get back online with some attack or something like that. When you get down to the data, it's not like they're putting down the U.S. financial system, but the number of people that have been scammed because of cyber and now AI has to run into the tens of millions.
Oh, for sure. And that's individual, but the second it happens across an entire institution,
yeah,
like a J.P. Morgan or whatever,
you know what the press is going to do about that?
That is going to be
because so much is amplified by the press right now. You even talk about COVID. Talk about the first pandemic. The stock market didn't react. Nothing closed down. I mean, just the information goes so fast, and it gets to be amplified. That's another thing that, scares get amplified.
Yeah, that's right.
That are not always real scares.
Yeah.
And that could paralyze the whole system in and of itself.
Well, I mean, look, if somebody goes into a major institution and takes even $100 out of every account, that's a legitimate scare. A rational person,
if someone
a
could do
rational
that.
person's going to withdraw all their money. You're going to have a problem. I think
That's right. All they have to
Yep.
do is, take a tiny amount out of everyone.
Yes.
We could look what happened in Silicon Valley Bank. It was just
Correct.
like a rumor
Yeah. Right.
that their bond market was, and then they lost all their
Yeah.
deposits within a matter of hours.
Yeah.
I mean, so you can see that sort of cascading behavior happening in this world of instantaneous communication,
Yeah.
and where, let's face it, the media hypes up a lot of stuff because they get ratings. Everyone hypes it up. You get more, looks, you get more ratings, and that's supposed to be positive. So everything gets amplified. So even if something happens that someone says, just a minute, we can explain that can happen again, that still could start a viral chain of
100%.
panic,
Yeah.
right?
Easier than ever today, I think.
Easier than ever.
Like that.
Easier than ever today. That scares me much more than the government deficit.
You mentioned Milton Friedman earlier.
Yeah.
And there's a video, I don't know if you've seen this video, where he talks about a pencil and all the
Yes, I'd
all
seen
the
that
things
one.
that go into a pencil and how they come from
Oh,
all
yeah.
over the world.
Free to Choose, his book.
Right. And so
Oh yeah, that's the beginning of his book, Free to Choose.
Interesting.
This
Okay.
pencil, I think it was in Hong Kong. He looked at the pencil and he said, "You know what it takes to put together this pencil?" Which at that time when he did it probably cost 5 cents.
Yes.
And he said the lead, all this, and it goes into all these different things. I mean, and this is the invisible hand of Adam Smith.
Right.
That everyone. The intricacies of how everything works together, no government could ever master it. Only the market can do it.
Right, and that the manufacturer of the pencil gets
Yeah.
all the pieces from all over the world to make the lowest cost,
Yeah.
best pencil. So that brings me to tariffs, because tell me what you think about Trump's new policies, which really go directly against Milton Friedman's teaching around basically the globalization of making a pencil.
Yeah. And basically, I don't like the tariffs. There are some bright sides, by the way. I don't think he went about it right. I mean, I think it kind of went to his head of his big victory, and then he wants to take over Canada and Mexico and Greenland, and I don't think that set the right tone, personally. And then attacking. India is a democracy, and we're putting higher tariffs on that than China. But let me tell you a little bit about the other side. We're in the United States is the only major country in the world that doesn't have a value-added tax, which is a consumption tax. We rely way too much on the income tax, which is very imperfect in many, many ways. And it actually taxes capital twice and 3 times. You go to other countries, they have dividend exemptions and all sorts of others that we just don't have. Most economists that study fiscal policy said we should rely more on a consumption tax. Now, tariffs are the kind of like a partial imperfect consumption tax on foreign produced goods.
Yeah, it's a
So
discriminatory.
it's like, anything here. I mean, I would like it as part of a general system to go to a value-added tax and lower the income tax. I mean, actually, theoretically, do away with the income tax and just have a value-added tax on all the goods. And the tariffs are a very imperfect beginning of that, but very imperfect, and not the way that I would start to introduce that. So I think the tariffs are net a negative for the U.S. economy and net a negative for the U.S. stock market. But there's a lot of other parts of the Trump agenda that are sufficiently positive so that we can still do well in the stock market. So, people say, well, how could you be against tariffs? And I was on the media against tariffs. I mean, you may have seen me. I was really saying, this is crazy. Especially the beginning of these reciprocal tariffs, the Chinese tariffs and all the rest.
50%.
But I'll tell you, people said, but then you turned bullish. And what made you started turning around? I know exactly the day I turned bullish. When Besson had the meeting in Geneva with the Chinese trade representatives, we had 35% tariff. Or we had 145 and they had 125, something crazy like that. And Trump was on the radio or on his tweets and saying, I think the best thing is going to be somewhere between 50 and 80. And what happened, at least in my mind, is Sunday night, Scott Besson called Trump and said, okay, they're willing to go down to 15 on us if we go down to 30. And he said, okay. I couldn't believe it. When I heard that, by the way, the market rallied strongly,
Right,
if you
yes.
remember that.
I do remember, yeah.
I said, oh, this is the way it's going to work.
Right. Then we had the taco trade. Like anybody that talked to
well,
him.
it was the taco trade,
Right.
which he took great offense to,
Yes.
if you remember. But nonetheless, I said, oh, okay. It's not going to ever be like this.
A negotiation.
Yeah, it's all going to be a negotiation. And by the way, you could see that they were negotiating. I mean, you could see as soon as they, stopped, selling the rare earths to us, we started, and turns out, now it is quite, surprising. There has been no retaliation. I mean, except for the Chinese
Right.
that retaliated the rare earths to get a very low rate on that. Basically, there's been no retaliation. I mean, even the Canadians, took back some of their retaliation that they had on that side. So they really like our market as far as that's concerned. And there's a lot of exemptions in its patchwork.
Yeah.
And I don't particularly like, you have to, go to the court of, Donald Trump in Washington to get that's not good capitalism. That's not good free markets as far as I'm concerned. So, I'm not particularly happy, but the amount of things that finally get exempted are really pretty high. Now, that doesn't mean that the average tariff rate is still going to be 15-17%, which is still very high from post-World War II standards. Although, again, I mean, we could eliminate the income tax with a 10% value-added tax, both on all tariffs and on domestically produced goods also, and we could probably eliminate the income tax. And still have a progressive system by exempting food and clothing or higher rates on certain what's called luxury items and lower on others. That's a much cleaner and easier way, especially when you consider that there's like 800 billion hours that the average person, not the average person, the cumulative U.S. spends on trying to, every April, do their income tax.
So you don't love the tariffs, but
don't.
you think we'll negotiate our way to a reasonable place. But you said you do like some of Trump's policies that you think are favorable. So tell me about that.
Well, I mean, first of all, that Biden was crazy antitrust, like with no mergers.
Yeah.
Spirit and Frontier Airmen, no Kroger, and
they're both bankrupt, by the way, now.
That's crazy. So he's much more done that. I mean, he's also lower regulation. I mean, he was in the first term, and we do have. I mean, the banks are overregulated. I mean, and it's a kickback from the financial crisis. I actually say a lot of the rise of Bitcoin is because of the overregulation of the banking system. But that's a whole other. We could spend an hour.
Well, you open the door.
We could open the door on that.
So
if you want to.
But I'd like to.
So there's a favorable on regulation. And let's face it, the tax bill. Is very favorable to capital. The immediate expensing of capital expenditures is very powerful. So when you take the tax bill, the deregulation that is there, the less fervent anti-merger movement, that offsets, more than offsets, the negative of the tariffs.
I see. Makes sense to me. Tell me about the cryptocurrencies. I'm curious how you feel. I don't know that I've ever heard your take on cryptocurrencies.
Yeah, well, okay, so I'm not an expert on them, you know. Let me say. I mean, you know, I have some of my colleagues that, you know, explain, you know, all the, you know, the works on it. I'm not an expert on it, but I always said that, I mean, our payment system in the U.S. is totally crazy. I mean, they charge merchants 3% for the credit cards, and then they give us 2% back. All right? I mean, that costs consumers like $900 billion a year. I mean, I get 2 of it back. Other people don't. They're paying 19% interest rate on their balances. I mean, it's crazy. In Europe, they put when the debit card became really popular, they were putting 1.5% on the debit card. You know, Congress stepped in and said, no, you can't do that. Do you know what credit card in Europe, the credit card limit is 30 basis points, and I don't know, I think the debit card's like 10 or 11. I said, we just have a terribly inefficient payment system. They're going to come up with an alternative payment system worldwide that's going to eclipse the dollar. And I think a lot of Bitcoin is to have an international system where you don't pay stupid, crazy fees, where you do it 24/7, which we should be able to transfer money. This idea the banks close at 3 or they open at 9, they're closed on weekends and every other house. I mean, this is stupid this is stupid in the modern world. We just and part of it is the banks are frozen because of all the excess regulation that resulted from the financial crisis. Sort of, I'm just doing, you know, what I need to do, and you know, I mean, I know some are making money, you know, Jamie Dimon, J.P. Morgan. I mean, they're making on side things, but the transaction technology is unchanged from 50 years ago. We should have, if we would have developed a transaction technology, I'm speaking incorrectly. We have the tools today to have a transaction technology that worldwide can transfer between businesses and individuals at 2 to 3 basis points anywhere in the world 24/7. And we haven't even begun to develop it. And why? It's being blocked by the monopolies of Visa and MasterCard, American Express. And no, we, you know, it's working well, and the banks love it because they're getting so much money from them too. I mean, so it's sort of it's not a conspiracy. But if what the Fed should have done years ago is said, all right, to the banks. If I were the Fed, I said, I'm going to have Fed money that's going to transfer there. But you know what? I'm going to give you guys if you want to do a private thing, I'll support it. Otherwise, I'll come in. Boy, that would have lit the fire under them. Mm-hmm. And then we would have 24/7. And you know what? We'd beat Bitcoin.
Speaking of 24/7, do you think the stock market should be 24/7?
It almost is. Yeah, I mean, it almost is with futures trading, all except a couple of hours. You can't do it but there's after hours on individual stocks, and you know, I mean, they trade during earnings, they trade after hours and earnings. That's all you care. You know, I mean,
Good
obviously
enough.
the world events you can trade in the futures market overnight. So
right.
you know, there's not a lot of company-specific things that happen during that. So you know, they're basically is 24/7.
And you're talking about the banking system, and you know now 85% of lending to businesses that have over 25 million in revenue happens in the private markets.
Well,
private equity.
And that's part of it. Part of it is just overregulation of the banking system. I mean, I just think it's a pendulum effect. You know, you go through history. So much of history is just a pendulum. We don't pay attention to something, and all of a sudden it happened, and then we go overboard on the other direction.
So what do you think about this? I mean, there were 8,000 publicly traded companies. We're now cut in half to 4,000, yet the economy's trillions of dollars more. Yeah. There's now thousands and thousands of private equity funds. The world has gone private. What do you think about private equity, private credit, this emergence of those as major
I think it
assets?
might be getting too popular. I'm not saying, you know, I mean, part of it Sarbanes-Oxley and the difficulty of going public. Some of that has been mitigated through subsequent legislation. That's, again, the reaction to Enron.
Yeah.
I mean, oh my God, a public company has to do this and this and this. That's why they didn't want to go public.
Right.
Now, some of that was fixed. If you go through it, but not a lot of it. It's hard to be public. It shouldn't be.
Right.
I mean, and that's another thing. So the regulation has created a lot of that problem.
With all the things we've talked about, what are you the most optimistic about?
I'm most optimistic of, and I'll tell you a story because it comes from being a professor for so long. I once had a really good Japanese student come into my office, and we started talking about it. And I was talking about education in Japan. I mean, they're very literate, very smart people. And I said, well, what surprises you? And he said, what surprises me is how the students question the professors. They can challenge the professors. He said, when I went to school, if the professor said 1 + 1 = 3 and put on a blackboard, you're not supposed to raise your hand and say there's a mistake there. You don't question that. There's a line of authority. What's great about the American culture is that we can question people. We can question people. We can challenge them. And it's socially okay. And it's socially okay to build a mousetrap that destroys the previous mousetrap company that might employ 200,000 people, but should only have to employ 10,000 people to do the same thing. In Japan, Toyota, all those big companies, you don't want to advise something that can hurt those companies because those companies are employing all these people. See, in the United States, we almost cheer for those type of people. That sort of creativity, we can, thinking outside the box, bust the tradition. We could do it, and you're praised for doing it. You're a hero for doing it. We're one of the few societies in the world that have that attitude. And I think that spark is what's really at the heart of American exceptionalism going forward.
Well, I love your youthful energy. Jeremy Siegel, one of my favorite people to follow in all of finance. Thanks for joining me today.
Thank you very much.